So happy birthday to the Dow Jones. Now it's had a rough and tumble kind of year this year, and I don't know what it might be doing as this episode drops, but as a certified financial planner and as a Bank on Yourself professional, I've spent years helping clients navigate the murky and choppy waters of personal finance and stocks in particular. And if there's one thing I've learned, it's that the mainstream financial media and typical investment managers love to peddle shiny promises like trust the stock market and hey, this thing's going to deliver double-digit returns over the long haul. They'll flash charts like the Ibbotson chart, which we'll talk about later, full of historical gains, and lean hard on the idea that the past is a reliable roadmap for the future. But there are some disclaimers at the bottom of all their charts and graphs that always say something like this: past performance is no guarantee of future results. Let's say that again. Past performance is no guarantee of future results. Well, what does that mean? It just means nobody knows the future when it comes to the stock market. Yes, the stock market might have gone up 25% over the last 2 years. Yes, it may have averaged 10% for the last 100 years. And you might have even gotten a 100% rate of return yesterday afternoon on that one cool rocket ship stock. But that's no predictor of what will happen today or tomorrow. It's all a guessing game. And that's what the disclaimer means. There's past performance is no guarantee of future results. And sure, okay, we get it. We're adults here. No one knows the future. But of course, we all know what happened in the past, right? But is it true? Do we even really know what happened in the past? Here's the rub for today's episode. What if the past isn't even what it seems? Stock market speaking, that is. So a recent Wall Street Journal article I stumbled across, the title of the article is "When Past Performance Doesn't Even Predict Past Performance." It backs up what I've been saying for years, that conventional wisdom about the market is a false flag. Guys, it's a psyop. You're being hoodwinked. It's a red herring. It's designed to distract you from what's really going on in your investment account or your indexed universal life policy. And I'll get into what I mean by that in just a few minutes. So this episode is not just about markets, but it's also about marketing. Marketing. In particular, something called backtesting, which is really just a statistical dirty trick that's central to Wall Street and even the insurance industry's marketing playbook. So let's get into it. Here's what the data itself says. So let's talk about something called an index. An index, like the Dow Jones, is an index. Let's consider how the Dow Jones, for example, is constructed. The Dow is price weighted. That just means the higher a company's share price, the more it contributes to the Dow's points. So stocks in the S&P 500, by contrast, are weighted by their total floated adjusted market value, their share price multiplied by the number of shares that they trade publicly. So Boeing, for instance, is 2.9% of the Dow. That puts it barely behind Apple at 3.3% because Boeing's 172 share price is close to Apple's 190 share price, at least prices as this article was written. So that's why Apple doesn't have a huge impact on the Dow. But Apple's adjusted market value of $2.7 trillion is 28 times greater than Boeing's $98 billion. So this makes Apple a far more meaningful stock, right? And it makes it more meaningful certainly to the S&P 500. If you add up the share prices of the Dow's 30 stocks, you'd get something like $5,850 if you were to buy the entire Dow, one stock of each of the 30 stocks in the index. A new stock at $1,000 a share would constitute 17% of the Dow Jones basket. It would unbalance the entire benchmark, essentially. So some analysts consider the Dow Jones now outdated, calling it 1896 mathematics. So it effectively precludes the Dow from adding such stocks like Eli Lilly, which was $815 a share, up 40% year to date as of the writing of the article, or Netflix, which was up 33% since it's priced at $648 a share. So all this got me thinking, how would a fantasy supersized Dow consisting of the 30 highest priced stocks have performed? Let's call it the supersized Dow. So let's get rid of Intel, which has only a share price of $30, and Verizon Communications at $40, and Cisco at $46. Let's bring in mega price stocks like NVR Home Building at $7,455, or Booking Holdings at $3,755 per share, and 28 other stocks with supersized prices, including Lilly, Netflix, Nvidia, all these mega priced stocks. Over the past 10 years, our special bespoke supersized Dow would have returned an average of 30.2% annually versus only the mere 11.4% that the real world Dow and 12.8% for the S&P 500 returned over the same period of time. So a $10,000 investment in our supersized Dow would have grown to $140,000, but only would have been $34,000 if we had put that money in the S&P 500. So which of those two numbers sounds better to you, $140,000 or $34,000? Of course, we would lick our chops at the much larger supersized bespoke index that we've created for ourselves, this Frankenstein of multiple companies baked into our supersized Dow index. So what's the catch? Why can't you just pulverize the market by buying these mega stocks and get the highest possible return on your money? Because of backtesting. That's why. Backtesting is basically a marketing ploy. The supersized Dow I just told you about would have outperformed, it's true, if only at the beginning of that period of time you bought the stocks that happened to have the highest share prices at the end of the period. Looking into the future is, again, something no one could have predicted. Who would have known 10 years ago that those mega stocks would have been the highest share prices in the future, 10 years later? If you had 10 years ago bought the stocks with the highest share prices then, you'd have underperformed the S&P 500 by an average of 1.3% points annually. All this assumes that you were able somehow to adjust your portfolio each January 1st so that your portfolio held the 30 highest priced stocks as of that particular date, that January 1st. As you know, that'd be logical. If you tried in real time, you could do that. But you also would have to trade for free. No cost to trade stocks. You'd have to reinvest all your dividends, and there'd certainly be no taxes. You couldn't pay any taxes either on this hypothetical, magical index we're talking about here. But by backtesting, applying hindsight to past data, and then pretending that a hypothetical portfolio had been run that way all along, financial marketers can make it look like it's just easy to outperform the overall stock market. It can make it look like your index is unbelievably powerful and that anybody choosing stocks the old-fashioned way or picking some other index fund is just a chump. So consider several target date funds. Now target date funds are something that most 401ks have baked right into them. And I'm going to look at a popular asset management firm. I'm going to take their name out of this, and I'm going to look at some of their real target date funds. These funds ramp up risk for younger savers and then dial it down as investors get closer and closer and closer to retirement. So this is the default asset baked into most IRAs and 401ks that if you've got a 401k, you've probably got target date funds, and most of them are going to be using a back testing strategy to convince the financial advisor to pick that fund. So this matters. If you've got a 401k, please listen up. So the unnamed investment firm's approach involves putting options, which rise in value when stocks tumble, into this target date fund, which aims to cushion losses during market plunges. In theory, this should give the investment fund manager a leg up. So had you put in $10,000 into their target retirement fund in January of 2013, you would have ended up with $23,091 by late March 2024, about a year ago. That's compared to $16,000 in the average rival fund per their figures. So yeah, looks like we have got a winner here. We've got a good financial firm. They're going to give us $23,000 over 10 years, let's say, versus the rival only $16,000. But here's the snag. You couldn't have invested in that particular fund back in January 2013 because the fund wasn't around yet. That impressive track record was mostly back-tested and theoretical. The fund only kicked off in October of 2023. So when you bought this fund, when you chose the prospectus or whatever, The past returns mentioned are only reflecting how it might have fared since January 2013 had it been around back then. So from stretches like July 2018 to May of 2020, from March to April of 2023, there's really no real data. These results are all simulated. So these target date funds are just a glimpse into the multi-trillion-dollar backtesting phenomenon that's, I think, pulling the wool over many investors and insurance policyholders' eyes. And we'll get to insurance in just a minute. Backtesting a stock portfolio is like claiming you were into avocado toast, craft beer, or Taylor Swift before they blew up and became really cool. It's a smug flex after the fact. So with backtesting, you're tweaking variables using 2006 data to prove your fund would have crushed the market, conveniently ignoring real-time chaos like crashes or fees or volatility. You're taking the winners and tossing them in your basket while leaving out the losers, and then hoping and praying that your buying public thinks that you're just a genius and that your fund will continue to outperform going forward. It just won't happen. I mean, it's like claiming in 2025 that clear back in 2006 you were into Taylor Swift, vinyl records, avocado toast, right? But it's as if you said, hey, I mashed up avocados on my toasted bread in 2006 before it was hip, but only after it's a brunch staple, right? I'm only saying that now in 2025. Or, hey, I loved Taylor before Fearless, while flashing Era's tour tickets. Both cherry pick the past to look like I'm smart or cool or hip, when hindsight's doing all the heavy lifting here. Asset managers frequently launch exchange-traded funds or target date funds tied to traits like liquidity or revenue that really shine brightly when historical data required it, but will fizzle as you go into the future. Why? Because past performance does not even predict past performance, not to mention future results. So for years, I've watched clients get lured into the stock market casino with promises of long-term gains, only to find out the house doesn't always pay out. So in my opinion, my doubts around backtesting only reinforces my approach with Bank on Yourself. So my feeling is, why not stop chasing unreliable past performance with backtested portfolios that don't even exist in the past, and instead build a strategy on something that doesn't hinge on Wall Street's smoke and mirrors in the first place? Investors should treat historical data, even the historical data, with a healthy dose of skepticism. Backtesting does not mean you'd actually achieve what it shows you on that spreadsheet that you're getting. And instead, you might want to focus on broader trends and also contractual guarantees with specific numbers. And that's exactly what a whole life policy gives you. It gives you a contractual guarantee that the money will grow at a particular amount every single year, regardless of market conditions, and not relying on some bespoke index that they had to go and backtest and cherry pick the winners and losers.